Rich individuals make use of debt in various ways to build wealth and enhance their financial portfolios. Here are 5 strategies that demonstrate how debt can be leveraged to create wealth. So in this video, we are going to discuss 5 ways rich people make money with debt. Now before we get into this video, make sure to hit that subscribe button and leave a comment below saying I subscribed. I will try my best to reply to as many comments as possible. Debt is a word that many people are afraid of. There are so many television shows, books, and magazines devoted to teaching people about getting out of debt. While debt can be seen as a negative measure, it can also be a positive one if used properly. The principal method of using debt to invest positively is the use of leverage to exponentially multiply your returns. What is leverage exactly? Leverage is using borrowed money to increase your return on investment. Leverage can allow you to achieve returns that you thought were impossible, but at a greater risk of losing your capital. Number 1. Margin investing. Margin investing is the practice of borrowing money from a broker to purchase securities. It involves depositing cash as collateral and entering into trades using borrowed funds. Margin investing can amplify both gains and losses, and investors may be at risk of losing more money than what they deposited into the margin account. Margin accounts are different from standard brokerage accounts, and investors must have a margin account to buy securities on margin. Investing on margin allows you to buy a higher dollar amount of stock than you actually have money for. For example, if you had $50,000 in your traditional brokerage account, you could leverage your investment and open a margin account. A margin account allows you to put up a max of 50% of the purchase price of a stock. You would have $50,000 in cash, and an additional $50,000 would be loaned to you from your broker. Your $50,000 investment gives you $100,000 worth of buying power. You could use this money and buy $100,000 worth of stock. If the stock price appreciates, then you can pay back the loan and pocket the profit. The negative is that if the equity in your account falls below a certain value, your brokerage firm can issue a margin call. If you can't meet your margin call because you don't have enough funds, your broker can liquidate your entire position in a stock, leaving you with losses. Number 2. Leveraged ETFs. Leveraged exchange-traded funds, ETFs, allow investors and traders to amplify their returns by going long or short on a particular index. Fund companies like ProShares offer leveraged ETFs that let investors multiply returns and losses between 200% and 300%. These funds let you invest in specific indexes, bonds, commodities, or sectors. Leveraged ETFs are attractive because of the extraordinary profit potential. During market booms, you can achieve returns with leveraged ETFs that other investors dream about. Leveraged ETFs are exchange-traded funds that use financial derivatives and debt to amplify the returns of an underlying index, stock, specific bonds, or currencies. While a traditional ETF typically tracks the securities in its underlying index on a 1-to-1 basis, a leveraged ETF may aim for a 2-to-1 or 3-to-1 ratio. Leveraged ETFs are meant for day-to-day trading, and their results over longer periods are unpredictable and can significantly compound losses. They have higher fees and expense ratios compared to traditional ETFs and are not long-term investments. The problem is that the same way that leveraged ETFs work for you is how they can work against you. Unless you are great at trading in and out of these funds, leveraged ETFs can magnify losses by wiping out your entire investment in a few days. Number 3. Hedge funds. Hedge funds are some of the biggest users of leverage. They are famous for generating abnormal returns by using leverage. Many hedge funds lever up to 10 times their total assets. Billionaire hedge fund managers like John Paulson have used leverage to turn accredited investors into multimillionaires. A hedge fund is a type of investment fund that pools capital from individual or institutional investors to invest in varied assets, often relying on complex techniques to build its portfolio and manage risk. Hedge funds can invest in anything from real estate to currencies and other alternative assets. The aim of all hedge funds is to maximize investor returns and eliminate risk, regardless of whether the market is going up or down. Hedge funds are generally seen as aggressive and risky, particularly when compared to mutual funds. They are not regulated as heavily as mutual funds and generally have more leeway than mutual funds to pursue investments and strategies that may increase the risk of investment losses. Hedge funds are limited to wealthier investors who can afford the higher fees and risks of hedge fund investing, and institutional investors, including pension funds. Hedge funds charge relatively high fees, with a 2% management fee and a 20% performance fee being standard. Hedge funds are loosely regulated by the SEC and earn money from their 2% management fee and 20% performance fee structure. However, if the fund manager's investment thesis is wrong, this can drive a hedge fund out of business and lose the capital of all investors. Hedge funds such as long-term capital management, LTCM, which needed a bailout, were levered up as much as 30 times their assets. Number 4. Short selling. Short selling is an investment strategy that involves selling borrowed securities with the expectation of buying them back at a lower price to generate a profit. When a trader or investor sells short, they are speculating that the price of the security will decline. If the price does indeed decrease, the trader can buy the security back at the lower price and return it to the lender, keeping the difference as profit. However, if the price increases, the trader may incur substantial losses, as there is no limit to how high a stock's price can rise. Have you ever watched a financial program on television and heard that it's time for you to short the market? Short selling is a popular way of betting against a particular security by borrowing shares from an investor and selling them in hopes that the shares decline. Short sellers have made a fortune by properly timing declines in stock prices. The downside to short selling is that losses are unlimited, which means that short sellers can lose much more than the initial investment. Number 5. Forex trading. Forex trading, also known as foreign exchange trading or FREX trading, is the buying and selling of currencies from around the world. It is a global marketplace for exchanging national currencies, with the goal of making a profit from the fluctuations in currency values. The Forex market is the largest and most liquid financial market in the world, with an average daily turnover of $7.5 trillion in 2022. Forex trading allows investors to control large blocks of currencies with a small amount of money. Currency investors can lever up their accounts 100 to 1. The pros of currency trading are that you can take a small amount of money and turn it into significant sums very quickly. George Soros is known as the man who broke the Bank of England, netting $1 billion by betting against the pound. Conversely, currency trading has the potential to clean out a trader's account in a matter of minutes. Let us know your opinion in the comment section below. This was all for today. Hope you liked the video. Subscribe to our channel and stay tuned for more interesting videos. Stay safe, and we will be back soon with another video.